Hello, my name is Febryanto with name 190230032. And over the next 15 minutes or so, I'm going to tell you what I think about PT Vale Indonesia, which trade as INCO is worth, and what the board should do about it. Let me be clear about how I approach a problem like this from the start. Valuing a company is really just telling a story about its future and then checking whether the numbers are consistent with that story. So, I'm not going to hide behind the model. I'm going to tell you my story for this company, so you the handful of assumptions that actually drive the answer, and be honest about where I could be wrong. And let me give you the conclusion first, and then spend the rest of the time earning it. Here is the conclusion. There is an old line like price is what you pay and value is what you get. Right now, the market is paying about $2.7 billion for this company. My estimate of what it's actually worth is about $5.5 billion. So there is a gap. And honestly, this whole presentation comes down to one question. Is that gap real, or am I the one who's wrong? Two things give me confidence it's real. First, I value the company in three completely different ways: a cash flow model, a second cash flow model from the shareholder side, and by comparing it to its peers. Those methods don't talk to each other, and they all landed around 5.5 billion. When independent methods agree, you pay attention. Second, I will keep coming back to this. I'm not betting on nickel price going up. The gap exists because the market is treating a bad year as if it lasts forever. That's the bet I'm taking the other side of. And let me put the honest habit on the table right now. This only works if the company executes. The nickel is already in the ground. The question is whether they dig it up and sell it the way they say they will. Okay. Let me set up the story, because the number only makes sense once you understand the business. INCO mines nickel in Indonesia. The old reliable part of the business takes ore and turns it into something called nickel matte, which is a half-processed nickel product, and sell almost all of it to long-term buyer. That part has worked for decades. The new part is growth to big new mines, but the single most important fact on this slide is the license. Their permit to operate expired at the end of 2025, and to renew it, Indonesian law required local ownership about 51%. That is why a state-owned company bought back in 2024. Hold into that, because it does two jobs in my analysis. It's the reason the company still exists, and it's the first of my M&A case later on. No license, no company, no nothing to value. Next. Now, anyone who pulls up the last 5 years of financial is going to get nervous. Revenue down, margin down, and return on equity from about 11% to under 3. So my first job was to answer a simple question. Is this company broken, or is it just having a bad year? I broke the return on equity into its pieces, the standard DuPont split, and the answer is clear. Almost all of the damage is in margins and in how hard the assets are working, which is the nickel price cycle. None of it is debt because they barely have any. A broken company has a broken balance sheet. This one has the cleanest balance sheet of any nickel company I compare it against. So my read, and it shaped everything that follow, is that this is a cyclical low, not a permanent decline. That one distinction, that one distinction is the whole investment case. Next. This is the most important slide for believing my numbers, so let me slow down. The biggest temptation in valuing a mining company is to assume the commodity price recovers, because then everything looks wonderful. I refuse to do that. I do not forecast nickel prices, so in my best case, I hold the nickel price basically flat for 10 years. Every bit of growth in my forecast comes from the company selling more tons, not from a better price. That is a deliberate choice, and it matters because it means my 5.5 billion does not depend on me being a good commodity forecaster. If price do recover, that's upside, and I'm not even counting. This is the main valuation, the discounted cash flow. The idea behind it is simple. A company is worth the cash it will generate in the future, discounted back to today, because money later is worth less than money now. Two judgment call drive this number, and I want to de- I want to defend both. First, the discount rate, about 11%. That rate is really just the price of risk and waiting, and I built it up from the bottom, including an extra premium because the company operates in Indonesia and not in a safe market. Second, the terminal value. I assume the company eventually stop earning more than its cost of capital because in a competitive industry, nobody earns excess return forever. That one honest assumption take more than $1 billion of my answer. I could have made the company look richer, I choose not to. And even after being this careful, every version of the model, a higher discount rate, lower growth, and all of it still comes out worth more than the market price today. Next. Let me deal with a fair criticism. So I strip the terminal value out completely and look only at the next 10 years of cash that I forecast line by line. Even on those near-term cash flow alone, the growth program adds about 2.5 billion in value and pays itself back in roughly 3 years. It survived my pessimistic case too, so this is not a house of cards resting on year 20 assumptions. The program earns its money in cash and I can actually see and defend. I also did a relative valuation, which just means comparing INCO to other nickel companies on simple ratio like price to earnings. If I value the company on this year, depreciate earnings, I get something close to the current low price. Of course I do, that's circular. I'm just confirming it's having a bad year. The honest way to value company that goes through cycle is to use normal mid-cycle earnings, not the bottom. When I do that, the peers say it worth 4 to 8 billion, and the middle of that range sits right on top of my cash flow number. So, two completely different roads building it up from cash flow and comparing it to the market and up in the same place. That kind of agreement is what makes me trust the answer. Next. I don't want to stand here and pretend I know the future to one decimal place because I don't, and neither does anyone. So instead of handing you a single number, I let the model run 1,000 times, and each run randomly through different prices and volumes at it, drawn from how those things actually move in history. Think of it as a stress testing on my own story 1,000 different ways. The result is the honest version of my conclusion. Even with prices bouncing all over the place, only about one run in nine comes out below today's market price. So, roughly 9 times out of 10, my analysis says the market is too low. That is not certainty, but it's a lot more useful than one guess and a prayer. Next. This slide is about flexibility, and it's the one place where standard valuation actually breaks down. INCO has the right but not obligation to invest a battery nickel plant called Pamala, which turn a lower grade of ore into a battery grade material. If you run a normal calculation on building it today, it loses money, but minus 140 million. And a textbook will tell you to kill it, but that misses the whole point. They know they don't have to decide today. They have a 5 year window to watch how price and demand develop and then choose. The right to wait and learn is worth something in exactly the same way a financial option is worth something. When I value the flexibility instead of the snapshot, it's flipped to a positive 116 million. So my recommendation is not build it and it's not kill it. It's hold the right, pay the small cost to keep it alive, and only commit if the price climbs high enough. A simple yes or no calculation would have thrown away something genuinely valuable. Next. How should the company finance itself? If we run the textbook optimization, the one that minimizes the cost of capital, it tells us to load up on the debt, around 90%. I want to show you why I affirm that. Because blindly following a formula is how people get into trouble. This formula is right about the steady state, but it ignores the timing. Right now, this company is in the middle of a heavy spending phase and is actually burning cash. Putting maximum debt on a company that's already cash negative is how a healthy company turns into a distressed one. So I use judgment. I target 20% of debt, a moderate level that stay safe even when I stress the earning hard. Next, dividend. I run the company under every payout policy I could think of, and I found something that genuinely surprised me. The total cash, the total cash that end up in shareholders' hands over 10 years barely changes. No matter which policy you pick, what changes is the timing and how much they have to borrow short term to do it. So the policy question here is about timing, not about how much. My recommendation is pay less during the heavy building years when cash is tight and then more once it's flowing. And here's the part I feel strongest about. The stock trades at about half of what I think it's worth, right? And when that's true, the single best investment is the company can make is the single best investment the company can make is own shares. Buying back $1 of value for 50 cents beats every other use of the money, including the acquisition on my next slide. Next, pre-M&A situation. The first is that 2024 deal where the state bought in. On the surface, it looked unfair. They paid about a third below market, but you have to ask the right question, which is always compared to what? The alternative wasn't selling at a higher price. The alternative was losing the license and the whole company being worth almost nothing. So even the sellers who took a discount came out ahead because the shares they kept because the share they kept became far more valuable once the license was secure. The other two more quickly, there are two more battery plant stakes INCO could buy into. On today's number, they lose money, so my answer is wait, with clear condition before committing. The more interesting one is a possible merger with Antam, another big state-owned miner. The savings from combining the two are real, but small, about 90 million. The problem is the exchange ratio, which is just how many shares each side gets in the deal. Here's the intuition. INCO is at the bottom of its cycles and Antap is near the top of its own. If you merge at today market prices, you are sweeping cheap shares for expensive one, and INCO shareholders end up handing over about 600 million of value to capture 90 million of savings. That math just doesn't work, right? So I would say not to merger. I would say no to the merger and share the infrastructure through a joint venture instead. You don't buy the whole company just to share a part, right? Okay. Next, unsustainability. My view is that ESG only matters to our valuation if it actually shows up in one of three places: cash flow, growth, or risk. Otherwise, otherwise it's just words. So I try to put a real number on it. It runs on its own hydropower, electricity from water, so its carbon footprint is less than half that of a coal power competitor. If the world ever start pricing carbon seriously, that clean energy edge is worth around $1.5 billion in today's money, and the market is paying them nothing for right now. The risks are real too, mostly sitting in those battery plant ventures, but they are small, and I've put condition around them. So on balance, the sustainability profile here is an asset I can actually value. not just a slogan. I bring it back to where I started. The market is pricing this company as if its bad year is permanent. My whole analysis say it is not. And so here are five things I would ask the board to do. Build the build the growth program because it pays for itself. Fund it fund it with the money they already have, with no new shares. Hold the option instead of rushing to exercise them. Go easy on dividend through the build and buy back the cheap stock instead. And protect the clean energy advantage because it's worth real money that nobody is counting. The one thing that would change my mind is if nickel demands break for good, not just for a year. Short of that, I think this company is worth close to double what it trades off. And the path to get there is not luck, it's executions.